With us here at Bloomberg Invest is Raj Dhanda, Global Head of Wealth Management at Ares Management. How are you?
I'm great, Carol. Good to be here.
It's great to have you here on a day where there's just an interesting market story,
Of course.
again, if you will. I am curious about the market volatility and what your read is on that. And I am also curious, your client base, does a day like this disturb them?
A day like this is actually the poster child for the value proposition of the private markets. The advisors we talk to and their clients are really frustrated by this type of volatility. We're essentially where we were, in early November
Right.
in the public markets, and that backdrop makes it really hard to work diligently on a portfolio that has above, at or above target returns. And at the end of the day, individuals have almost as much wealth as institutional clients. They've just never had the access to the private markets, and that's starting to change. A lot of our discussion is not just should they invest in the private markets, but it's how.
Hmm.
All that said, a day like today is distracting at a minimum because most of our clients still have 80 or 90% in the markets, and the headlines and the volatility are going to certainly be a distraction at a minimum.
So would you say that, yes, today is a poster child certainly of why people invest in privates, but would you say it's also a reason why people should consider allocating more of their portfolios to privates?
I would, and I think the investment thesis is what really comes out at a time like this. We're quite clear that the private markets are illiquid. That's why you get a higher risk-adjusted return.
Yeah, you can't just call up and sell
And
when you want to.
The top advisors that we work with will tell you that keeping their clients invested can be challenging, particularly, again, at times like this. Imagine if you sold, earlier today, and then the headlines tonight potentially reverse some of the momentum behind the downtrade, right? That would just
Yeah.
be a really tough day. But the private markets in 20 years have changed completely in terms of the breadth of solutions. You can invest in sports and media assets. You can invest in real estate and infrastructure. You can have some durable income solutions from private credit. So the way we think about it is you should have equity exposure. You can do that in both the public and the fixed income markets.
Right.
You should have some kind of credit or income. You can do that in public and private markets. And then you should have some real assets. You should own some real estate. You should own some form of infrastructure is a really tax efficient solution. So, and you can do all of that in both the public and private markets. You couldn't do that 20 years ago, even 10 years ago.
I am curious, we're so Washington focused right now, and you can understand why, right? Because there's so much that's coming down, and some of it does impact the markets. We mentioned the headlines from the Commerce Secretary, Howard Lutnick, that the president may now lower Canada-Mexico tariffs tomorrow. And so this is our world where it can turn 180 in less than 24 hours. We're going to actually be talking to the Commerce Secretary tomorrow on Bloomberg. What I'm curious about is when it comes to private markets, are there constructive conversations you guys are yet having with the administration or that you think have to be had when it comes to private markets?
There are certainly conversations to have with any administration around
Right.
the evolution of the private markets and how to make it easier to invest in the private markets. Ares has been in business for over 25 years, and so we've worked with many
Right.
administrations. This one is just getting their feet
It's early.
on the ground. It's early. They're certainly pro-growth and pro-business, and so some of that narrative we support and are happy about. But I would say they haven't yet really dug in on the type of change that would have a day-to-day impact on what we're doing.
And maybe a smarter question is, you're right, it's early on. But I mean, what would you like to see in terms of what happens for oversight in terms of private markets? You and I talked ahead of this conversation, and one of the issues is the transparency issues. And I know you talked about what you guys do in terms of, I guess, spreading around risk, right? It's not like you're one investment in one particular investment when it's the private markets. It's multiple investments. But what do you think needs to be government oversight or what? You provide transparency to your investors, but does there need to be something more?
Well, I'd step back because you're getting at something that's sort of paramount to any type of investment approach, which is manager selection and the diligence that goes into an investment firm's track record. And
Right.
and so as the private markets grow and as there's a significant amount of new entrants, there are going to be firms that may not have a 25-year track record or may not be able to speak to prior periods, whether it was the GFC or the emerging markets or other challenging times. So we definitely think in any of the, whether it's private credit or real estate or secondaries, all these areas, a 20, 25-year track record is really helpful.
Right.
And not everyone has it today in the private markets. We think the expectations related to transparency are no less in the private markets than the public markets. Institutional and high net worth clients expect us to provide them a significant amount of transparency.
Today already.
Today. So we don't think of what we do as changing that commitment to our investors.
What do you think about private opening up to more retail investors? And then does that change in terms of the transparency issues?
Well, so of course the growth that you referenced, that we talked about on our earnings call at Ares, this sort of marriage of alternatives in the wealth channel
Right.
is a secular trend, democratization of alternatives. That growth is being driven primarily by individuals with over $1 million to invest. In the U.S., that addressable market is in excess of $80 trillion and grew beyond that last year. So that's plenty to do. They all are still struggling to grow an allocation. Some of the limits on their allocations are where you're going, which is there are state limits on how much they can allocate. There or in some cases, federal oversight that limits the allocation. Individual banks have their own suitability requirements. But fundamentally, this high net worth individual that has over $1 million to invest gives us a massive runway to provide education and new solutions.
So you're referring to accredited investors, correct?
That's right.
There are some folks in your industry who say we need to essentially say we need to get rid of those rules about accredited investors because it will give more opportunities to folks to get in on deals early and have more upside. It doesn't sound like you're actually saying that. You're saying that accredited investors, there's enough dry powder there essentially for you.
No, I do think that over time, as we work to investors that even less to deploy lower sophistication, there's an opportunity to provide them solutions they don't get today. But, a big part of what we do is not just raise money, but deploy it. And the fundraising and the growth in the private markets is, driving a lot of the headlines. But one of the things we want to make sure is it's deployed reasonably, thoughtfully. And Ares has got a real commitment to local origination, whether in real estate or credit or any of our areas. And we were talking before the call about how important it is to build portfolios with small single investments, so you're very diversified. ARCC, which is one of the largest public BDCs, the single name exposure there is 2.5 points. It's not a concentrated set of bets.
It's really spread out.
And to build that type of a portfolio, you need to be able to have a significant feet on the ground and origination.
Right.
So, but yes, do we think that non-accredited investors are a growth area for the firm? Absolutely. But we think we're in the early innings of the high net worth investor allocating more to the wealth channel, and there will be a time when non-accredited investors will also get access to what we do.
Raj, how much bigger do you think the private credit market gets? I mean, it's just an incredible kind of explosive growth that we've seen just in the last couple of years. And you and I talked on the call in great context, reminding us that still the public markets are so much larger. But does it get to a point where the private markets rival certainly on the equity side of things, or is that just crazy?
Well, I think it provides a really attractive solution. It's floating rate. In 95, 96% of the loans are floating rate. That's an important aspect because it minimizes the volatility that we've now seen with fixed income. Private credit is also higher yielding, and um, we're asked often, how much, what do we think of the growth? It's actually, the growth is not really outsized versus private equity. It just has gotten a lot of attention in the last few years.
Okay.
Think about any sort of typical LBO, you need 2 quantums of debt for every amount of equity. So to have a proper functioning economy, the private credit has really stepped in and addressed some of the concerns where banks don't provide as much capital, where you don't find other solutions.
So, oh, go ahead.
I was just going to say there are some critics out there who say that there's not the same oversight with private credit that there is with traditional lending through banks. Banks would like to say that. I'm wondering if on your radar there's concern that there could be more regulation coming for private credit.
I worked at a large bank for a while, and I understand that. There's not the same leverage with the investment managers as there is, or there used to be, with banks. There's also an appropriate matching of capital and deploying it. So we have investors that provide us long-term capital, and it can't be called on the short term. So actually, the large players in the private credit markets are very, very different than banks when they were lending either at the peak or even after the GFC. They don't have the same leverage. You might have 1x leverage. They don't have the same volatility in the capital they're deploying. So it's a very different value proposition. It's not the same threat to the economy. We're not taking deposits from individuals and so on.
In terms of the macro conversations that are out there, whether it's over Fed policy or rates or regulatory oversight, whether it's about war, what is the most important macro conversation to your world right now?
The most important thing around the macro conversations is that we're aware of all of it, but we think of ourselves as micro and in a position to really focus on 2,000-3,000 middle market companies across the U.S. that we invest in, and not get too caught up in the macro, which we've been through, as I said earlier, for over 25 years.
Just one follow up on that. I love the middle market. I think it's such a great slice of the economy. Those middle market companies doing okay? Are they seeing stress? Are they seeing strain?
Yeah, I mean,
And I know it's hard to lump everything, but I'm just curious.
yeah, so we tend to avoid some of the more cyclical sectors. We focus on services as opposed to goods in a lot of cases. But yes, we are by and large seeing better cash flow, better performing balance sheets than some of the markets might suggest.
Okay, so that's optimistic. Yeah. Hey, listen, thank you so much.
Of course.
Really appreciate it. Raj Dhanda, he's Global Head of Wealth Management over at Ares Management.